What's going on, guys? Welcome back to another video. In this video, I've got another AMC update to bring all of you this afternoon. So what we're going to be taking a look at in this update is a brief analysis on the Ortex short interest and utilization data going into next week's trading week to get a better understanding of where we are at in terms of the short squeeze side of this investment. Now, with everything that has kind of come out this weekend with Mark Cahote's interview on Matt Korz's channel, if you guys have not gone and checked that out yet, you definitely should. It is an awesome interview. There's been a lot of talk surrounding derivatives and the option chain. So I want to go through exactly what I am seeing on AMC's option chain at the current time and just explain to you guys how what we see on the option chain really makes or breaks us every single week. And we're going to make some extensions of this to really show you guys how deep this situation actually goes. Now, the second thing that we're going to be going over is a really weird situation that Citadel keeps getting themselves involved with. Now, one of these things is going to be this lawsuit against the SEC in terms of IEX's new DLimit order, and we're going to go over exactly what that is. But there are some other things that Citadel has been up to that really shows signs that they are struggling and they are worried about something happening. So we're going to take a look at all of those things, explain exactly what is going on, and really just show everybody that the efforts that the ape movement has really gone through over the last 8 to 9 months, we are trending in the right direction and everything is starting to work. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button. So when we come over and take a look at this Ortex data, again, utilization 87.61%, not really high enough to really put a lot of pressure on these lending institutions, but we are seeing the short interest hanging out around this more recent high after we got the update after the exchange reported short interest did come out. Now, I do expect to see this short interest still trend upwards over the next couple of months, and I do think the utilization is going to start on that uptrend again as well, just because of the nature of these outstanding short positions. They could have covered at 2, they could have covered at 5, 10, 20, even all the way as high as we are trading at right now, but they still haven't yet. So something is going on behind the scenes, and we are going to take a look at that a little bit later. So when we come over and take a look at the option chain for AMC, this is what I really want to get across to you guys. When you're thinking about buying or selling options, you got to think that for every action, there is always going to be an equal and opposite reaction. And in this case, that is going to be the hedging process. So when we're looking at the option chain going into this week, again, there's not really that big of a potential for a gamma squeeze. And what we would expect to see, especially just by looking at the open interest on the option chain right now, is that we would see a hedge more geared towards the long side due to those institutions having to go out on the open market and buy shares in order to hedge those options. Now, this is kind of where we get into the concept of max pain, and going off something that I have heard a couple of people talk about, that the derivatives market is really, really important to this situation. We have seen the max pain price right around this $39 mark over the last couple of weeks. Now, when we trade pretty close to that max pain by the end of the trading week, the market makers or any option sellers who are taking the opposite sides of these trades or are actually going out and selling you these options, they pretty much end up okay. But when we see kind of a disjoint or something that happens in the underlying stock where we trade much further away from that max pain price where the vast majority of these contracts expire worthless, that is when a lot of these institutions get hurt. But what we typically see is that we do trade around these max pain prices. So there is a positive and a negative side to purchasing weekly options. But again, you have to be very, very careful when you are trading options, especially on a volatile stock such as AMC. Now, moving on to the next logical step in this, I want to bring you guys back to something that I have been talking about in my live streams and a couple of videos over the last couple of months, and the fact that it may not actually be the hedge funds that are responsible for this, but the market makers and the prime brokers. Remember the example that if you give a child, let's say it's 10 pounds of candy, they eat it, they get sick, they have to go to the hospital, who is really to blame for that situation? Is it the child for eating the candy, or is it the person that gave them that candy? And when we come over here, when looking at this screenshot from MarketBeat, this is supposed to be the top institutions that have short positions on AMC, but that's not exactly what we are looking at here. This is essentially the position size in terms of what these institutions are holding in terms of put options. Now, going back to that hedging process, whoever has sold these institutions all of these puts need to hedge that position. Now, they can buy offsetting put contracts in order to maintain that delta neutral status, or what their computers can do is they can go out and directly short the stock. Now, if it is a market maker facilitating these transactions, they can essentially naked short legally, and that is not going to show up in the short interest at all. The other thing that you have to keep in mind with all of these institutions and what we are looking at in terms of this data is that it's kind of cherry picked. Now, Bank of America, for example, we went over this in the past, but they actually have a net long position on AMC. They have shares, they have calls, and they have puts. Now, having calls and puts, but not being able to see what the expirations or the actual strike prices of those specific contracts are really puts retail investors at a disadvantage, because what you can do with those different positions is you can essentially create those synthetic shares. But we are moving in the right direction in terms of short interest reporting. And this is something that I brought up a couple of times. This is from FINRA 21-19. And what we see here is this is a new rule that really wants to increase short interest reporting instructions. Synthetic short positions. In addition, FINRA is considering requiring firms to reflect synthetic short positions in short interest reports. For example, enhanced short interest reporting could include synthetic short positions achieved through the sale of a call option and purchase of a put option where the options have the same strike and expiration month, or through other strategies. We've gone over a couple of them through those SEC reports, but FINRA believes this information would assist FINRA in understanding the scope of market participants' short sale activity, specifically regarding the use of less traditional means of establishing short interest. So what this really comes down to is the fact that, one, retail investors at the current time have maybe 5% understanding of what we are looking at in terms of short interest and the data in the overall market. But what we really need in order to make this market even more free and more fair is just more transparency, not only with short interest reporting, but through a variety of things as well. Now, let's get into the Citadel situation, because what their actions are telling us and what they've done over the last couple of months is very, very interesting. So when we come over here, I've gotten a couple of messages that a lot of people want to go through this situation again with Citadel Securities suing the SEC over approval of new stock order type. So this is a really interesting situation. And to me, this does not make a whole lot of sense as to why Citadel would want to do this. Citadel Securities, which provides trading services to asset managers, banks, broker-dealers, and hedge funds, has sued the SEC over its decision to approve a new mechanism for trading stocks at Upstart Exchange operator IEX. So that is the investors exchange. So the SEC failed to properly consider the costs and burdens imposed by this proposal that will undermine the reliability of our markets and harm tens of millions of retail investors. Now, that's according to Citadel. So the lawsuit, which was filed on Friday, this was actually a while ago, was first reported by the Wall Street Journal, increases Citadel Securities' dispute over IEX's DLimit order type. Now, when we come over here, October 25th is going to be when this court hearing actually happens. So that is going to be an interesting date to keep in mind. We probably won't see anything come out about this hearing on October 25th, but this is going to be something that we need to keep a lookout for going into the next couple of weeks and months after this court hearing actually takes place. But let's go over exactly what this DLimit does and how it would benefit retail investors. So discretionary limit behaves like a regular limit order, except when the IEX signal predicts the price is about to change. This triggers DLimit orders to automatically reprice to 1 MPV, minimum price variant, 1 penny for most stocks outside that level. Now, the details of this repricing we can see right here. We're going to break this down really simply for everybody because there is a very simple explanation. But when the CQI predicts that the price is about to change, the national best bid is moving down or the national best offer is moving up, the DLimit buy-sell orders are repriced. Now, what this is essentially going to protect against is essentially the high-frequency traders basically sniping your orders and coming in and taking them from you and basically front-running you. But here's what we need to think about. So Citadel is suing the SEC over approving this new limit order. Well, the IEX exchange isn't that big in terms of like the New York Stock Exchange and the NASDAQ, and this is just one type of order that you can enter. Is Citadel really that worried about a small new type of order coming in that they need to basically try to put out a lawsuit that is going to stomp this out? And again, this is going to hurt Citadel because they do a lot of high frequency trading, and what their market making activities can do is they can front run a lot of these orders, and the DLimit would help prevent against this. Now, when you combine this with the fact that Citadel has recently pulled money from Melvin, it also suggests that throughout January and maybe even the June run-ups in AMC and GameStop, they still had a lot of exposure on the short side on a lot of these trades, and they were trying to protect themselves against a massive fallout. Now, again, this isn't the only thing. We have the DLimit, we have Citadel pulling money from Melvin. The last thing that I think is really, really important is all of those cease and desists that Citadel has been putting out and issuing based on all of those banners that is coming out. Now, in my opinion, Citadel really should have a lot better things to do with their time and resources than care about some banners, a small limit order, and this Melvin Capital situation. So what this does show us is that there is really something going on behind the scenes that Citadel may be having a lot of issues at the current time. And when you combine that again with all of those tweets that Citadel was sending out that essentially contradicted everything, it really seems like they are flailing at the current time and very, very worried about what is going to potentially happen in the future. So that is really going to wrap up this update on AMC. And remember, I do think that we have a lot of bullishness coming in the near future, basically just based on that earnings event coming up. And it is very possible that we do see an earnings run-up. Basically, people expecting to see really solid blowout numbers from AMC from their Q3 earnings. So that is going to wrap up this update. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. Cost you nothing to do it. And if you guys want to see more videos like this, make sure you hit that subscribe button. So I hope you guys are having a great day, and I'll see you guys in the next video.